Okay, so you're a country sitting on oil, or you're an oil company deciding what to do with the crude you just pulled out of the ground. Here's the pitch: refine it instead of selling it raw, and you make way more money. Saudi Arabia did it. That's the story everyone points to. Here's the reality: refining oil is one of the most capital intensive, unforgiving businesses in the world. And the reason most oil producing nations never actually pull it off isn't laziness, it's that the cost and the risks don't show up all at once. They show up slowly in the form of a $5 billion plant, a decade of construction, and years where refining flat out loses money while the guy just pumping crude out of the ground still walks away with a profit. So let's actually walk through this thing dollar by dollar, from the price of raw crude to the number that actually tells you who wins. Start with what crude oil even is, because most people get this wrong. It is not fuel. You cannot pour it into your car. It's a tangled mixture of thousands of different hydrocarbon molecules, some light, some heavy, some worth a lot, some worth almost nothing, all mixed together in one barrel. When a country sells that barrel raw, they're selling the whole unsorted mixture at whatever price the global market sets that day. As of mid-2026, that price has been sitting somewhere around $70 to $85 a barrel, depending on the grade. No negotiating, no pricing power. That's the number, take it or leave it. Refining is the process of splitting that mixture apart into things people actually want: gasoline, diesel, jet fuel, kerosene, asphalt, and the raw material for plastics. Saudi Aramco's Ras Tanura complex alone processes several 100,000 barrels a day, one of the largest refineries on the planet. And here's the number that gets thrown around online that's flat out misleading, so let's fix it right now. People say the refined products from one barrel sell for a combined $120 to $140, so refining basically doubles your money. That's revenue, not profit. Before you get anywhere near profit, you have to subtract the cost of actually running the plant, and that's where this entire story really lives. Refiners track this with something called the crack spread. It's simply the gap between what you paid for the crude and what the finished products sell for before you touch a single dollar of operating cost. Think of it like a restaurant's food cost margin, not their actual take-home profit. In a strong market, that spread might run $30 to $50 a barrel. In 2022, when fuel demand snapped back hard after the pandemic and supply stayed tight, crack spreads blew out to levels some refiners hadn't seen in over a decade. Exxon posted downstream earnings that quarter that were multiples of their normal run rate. Now rewind to 2020. Demand collapsed so fast that crack spreads in some regions went negative. Refiners were losing money processing oil into fuel nobody wanted to buy. Same industry, same equipment, 18 months apart, completely different outcome. So before you even get to that swing, you have to survive building the thing in the first place. A modern refinery runs $5 to $15 billion, sometimes more, and takes close to a decade before it's fully built and optimized. Compare that to drilling a new well, which for a smaller onshore operation might cost a few $1,000,000 and start producing within months. Selling crude is fast money. Refining is a 10-year bet on a market that has already proven it can flip from record profit to outright loss in under 2 years. And here's the trap that catches almost everyone who thinks just build the refinery is the whole plan. Once it's built, the money doesn't just start flowing. Refineries eat cash constantly, not once. Continuous maintenance is required, and shutting one down for repairs, even briefly, can cost millions in lost production per week. They burn enormous amounts of energy just to run, which is now part of your input cost, not free. They're under strict safety and environmental regulation that varies wildly by country. And one serious accident, like the 2005 explosion at a refinery in Texas City that killed 15 workers, can cost hundreds of millions in fines and repairs, plus years of reputational damage. None of that shows up when people compare crude prices to gasoline prices online, but it eats directly into that crack spread every single time. Now, here's why some countries still commit to it anyway, and why others get punished for not doing it. Nigeria is one of Africa's largest oil producers, pumping well over 1 million barrels a day for decades. But for most of that time, its refining capacity fell far short of what the country actually needed. So Nigeria exported crude cheap, then turned around and imported refined gasoline, diesel, and kerosene from refineries in other countries, paying for someone else's processing, shipping, and profit margin on fuel made from Nigeria's own oil. That's not just a missed opportunity, it's a structural dependency that compounds every year it isn't fixed. And it's a big part of why Nigeria has cycled through fuel shortages and subsidy crises despite sitting on massive reserves. Saudi Arabia took the opposite bet. Through Aramco, the country poured money into downstream refining and chemical products, becoming not just the world's biggest crude exporter, but a major exporter of refined fuel and chemical products too. That didn't happen fast, and it wasn't free. It happened because Saudi Arabia had the capital reserves to absorb a decade of construction costs and market swings, reserves that most oil-producing nations simply don't have sitting around. That's really the whole trade-off in one sentence. A crude producer is a price taker. Whatever the global market says that day is your number. No room to negotiate. A refinery gets access to higher value products, but takes on massive fixed costs and a margin that can evaporate in a bad year. Exxon and Chevron hedge this by doing both, extraction and refining, a strategy called vertical integration. It doesn't guarantee profit everywhere. What it actually does is smooth the ride. Cheaper crude means cheaper input costs, so refining margins often hold up when crude prices fall. When crude prices spike, the upstream side usually picks up the slack. Owning both ends means you're rarely getting hit on everything at the same time, which is a very different claim than refining always wins. And that's the biggest mistake people make analyzing this industry, assuming refining is just structurally more profitable full stop. It isn't. It's dramatically more profitable in some years and dramatically less in others, and the swing between the two can be enormous. In good years, integrated refiners post historic numbers. In bad years, refiners can operate at a loss, while crude producers, sitting on far lower fixed costs, still walk away in the black just from pumping oil out of the ground. Refining trades a lower floor for a higher ceiling, and that floor can genuinely drop out from under you if your timing is wrong. So what does the real profit potential look like averaged out over time? Companies and countries that control both extraction and refining tend to outperform those who only sell raw crude across a full market cycle. Not because refining is magic, but because it gives you more places to capture value and more ways to survive when one part of the chain turns against you. But that outperformance only comes after clearing $5 to $15 billion in upfront capital, years of construction, hundreds of millions in annual operating costs, and margin swings that can wipe out a quarter's profit overnight. It is not free money sitting on the table waiting to be picked up. It's a bet that only pays off if you have the balance sheet to survive long enough to collect on the good years. Which brings us back to the actual question: refining oil versus selling crude. Which one really makes more money? It depends entirely on which year you're asking, and whether you have the capital to survive the years when the honest answer is neither. Selling crude is the low-risk, low-ceiling option. Fast cash, zero infrastructure gamble. But you're permanently stuck as a price taker, with no room to capture extra value. Refining is the high-risk, high-feeling option. Real potential to capture 2, 3, sometimes 4 times the margin of raw crude in a strong market, but only after clearing billions in capital costs and surviving the years where that same bet loses money. Countries that got rich doing this, Saudi Arabia among them, didn't get rich because refining is automatically better. They got rich because they had the patience and the reserves to survive the losing years long enough to cash in on the winning years. That's the part nobody puts in the pitch. It was never really oil versus refined fuel. It was always about who could afford to wait.